Hey, welcome in everybody. One of the big questions I get this time of year is people wanting to know if they're able to make contributions into a Roth IRA. So for a lot of individuals, contributions into a Roth IRA are not allowed because they make too much money. There is an income limit, and if you exceed that income limit, and those limits are different depending on how you file your taxes, but if you exceed that income limit, the IRS does not allow you to make traditional contributions straight into a Roth IRA. However, for a lot of people, that doesn't stop them because there's a rule or a get around that people oftentimes take advantage of, which is the Backdoor Roth IRA contribution. And essentially, instead of taking money and making a contribution directly into a Roth IRA, they will place money into a traditional IRA because that does not have an income limit associated with it, and then make a subsequent conversion from that money sitting in the traditional IRA into your Roth IRA. And again, that is totally legal to do because there is no income limit to make a conversion. There is only an income limit to make a contribution into a Roth IRA. However, before people go about doing this, if it's something they're considering, there is one important rule that you're going to want to be aware of to make sure it doesn't blow up your strategy of making a backdoor Roth conversion. And that is the IRS aggregation rule. And it essentially is there to keep people from taking advantage of this backdoor Roth conversion strategy while also holding additional IRA dollars out there to their name. So, for example, this rule works where we have Bob. Bob wants to make a backdoor Roth conversion. But before he does, Bob has a traditional IRA sitting out there right now for $650,000. It was money he had in an old 401k that he rolled over a long time ago. But he exceeds that income threshold to make a traditional Roth contribution. So Bob decides he wants to proceed with a backdoor Roth IRA conversion for $7,000. He's going to contribute $7,000 into a traditional IRA and then convert it into a Roth IRA. Therefore, he is getting around the rule of not being able to make the contribution into a Roth IRA because instead he's making a conversion into the Roth IRA. However, the aggregation rule that the IRS has set up is basically seen as all of your IRA dollars are combined into one. So if Bob were to proceed with the strategy, the IRS would see his $650,000 traditional IRA and the $7,000 contribution he'd make into the non-deductible IRA as one. So the IRS would see him holding an aggregate of $657,000 in IRA assets. That $7,000 of non-traditional IRA money that he's hoping to convert is 1.07% of the total IRA assets the IRS sees him holding. And this is important because when Bob goes to do the backdoor Roth conversion, only 1.7% of his $7,000 conversion will be seen as being made tax-free. The other $6,881 will be considered a taxable conversion because the IRS will have seen that that amount of money will have been taken out of the total pot, which is the $657,000, and the majority of that money is considered to be part of the $650,000 traditional IRA. So with a large traditional IRA sitting out there, and then Bob subsequently trying to do a backdoor Roth conversion, it essentially won't do him any good from a tax planning standpoint because the large majority of that conversion will be taxable to begin with anyway. So this is extremely important for a lot of people out there who are thinking about doing a backdoor Roth conversion who already have traditional IRA assets out there to their name. One way that people could get around doing this is maybe transferring that IRA money into a 401k if they have an employer plan that allows them to do something like that, because that would get those IRA dollars basically out of their name, which would free up the contribution into a non-deductible IRA and then subsequent backdoor conversion without running into that aggregate rule.